Welcome back to another session. We're going to continue from where we left in the last class. In the last session, we talked about P&L, balance sheet, cash flow statement. I just mentioned, though I did not describe it. I did talk about what is a financial year. We did talk about what do you call it as the contents of the income statement, that is our income and expenditure statement as revenue and expenditure, as you can see on the screen out there. We did talk about accrual concept. For explaining accrual concept, I did take some examples also for accrual concept out there. And then we talked about what do you call it as, we talked about the next aspect of with what frequency do you prepare what is called as an income and expenditure statement, and what is the specified time period. As I said in the last class, the income and expenditure of the profit and loss account is for a specified time period. So, it basically takes into account all the accrued revenue and accrued expenditure for that specified period. That is what we talked about, accrual concept, in the last class. Then I did mention about the balance sheet. I said balance sheet is what you own and what you owe as on a specified date out there. You take a specified date, today, end of today, what is it that you own and what is it that you owe is what we talk about out here. And when we say own and owe, we say own and owe with regard to the specific entity. Please note that entity concept I did describe in the last class. We talk about a specific entity. For example, I said that I start a company tomorrow. I am an independent entity, the company is another independent entity out there. So, we are preparing the books of the company, the balance sheet for the company, that is whatever the company owns, that company owns, not what I own and what I owe. What I own and what I owe is different, because the entity, that is a separate entity, non-living entity out there. So, that is what we talked about in the entity concept. And beyond that, we will take up some examples and see. So, what I have tried to do is, I have tried to build an Excel sheet out there. I have just given you this Excel sheet. I said there is what is called as liabilities and equity. Sir, what is liabilities and equity? Equity you never mentioned. Don't worry about all that now. We will sort of talk about equity as we go along. And there is what is called as an asset out there. There is some kind of a revenue and there is some kind of an expenditure out there in this particular case, and that is what we basically see out here in this particular case out there. So, what are we trying to do out there? The purpose of doing this is for you guys to know, for all of you to know, that any transaction we take, any transaction that happens, that is what I said, the transaction is initially entered in a journal, then posted in the ledger, then goes to trial balance, whatever it is, etc., etc. So, ultimately what happens when it is all consolidated, it gets consolidated in the form of P&L or income statement and balance sheet. So, in short, any transaction that basically happens in an organization will have to impact both the balance sheet and the profit and loss statement at any point of time. At any point of time, any transaction that basically happens will have to impact the balance sheet and income statement. That is why these are all finally called as what is called as the financial statement, the final financial statements of a company, because bottom line, this has to reflect all the impact of all the transactions that have basically taken place. This has to reflect the impact of all the transactions that have taken place. That is why these are all what is called as financial statement. What about the cash flow statement? We will come to the cash flow statement a little later. Let us take this. Let us say balance sheet of, for example, of XYZ. I am just going to give an example of the XYZ. Yeah. It's, as I said, it's on a particular day. Let us not worry about which day. Income statement for XYZ. Income statement of XYZ for the period. We'll fill the period out. Now imagine, as of today, imagine the business starts today. I start the business today. I am an individual, I have started a business, or a group of people have started a business today. That business is called XYZ out there. Now, they contribute some money to the business in the form of capital. Say there are two people who join together and do a business, and each one has contributed about 10 lakhs to the business out there. Let's take it for that matter. That is, me, I am here, my TA is here. So both of us have contributed 10 lakhs to the business. We have formed an entity called XYZ. It's an independent entity. That XYZ has collected 10 lakhs from two of us out there. What are we? We can be the manager, the CEO, we may not have any role in the organization. That's all different. Let's not worry about all that. The entity XYZ has collected 10 lakhs from my TA out here, Suhail, and 10 lakhs from me. So they have collected totally about 20 lakhs out. Entity has collected 20 lakhs. So now what happens? We are talking about what you own and what you owe. That is what, when I said assets out there, I will basically say what you own out here, and then liability and equity. In short, I would basically say what you owe out there. So, moment the business, the entity XYZ has collected 10 lakhs from each one of us, that is, it has collected 20 lakhs from us, the entity owes that money back to us. When the entity owes that money back to us, when the entity is going to wind up, that is what it is, the capital. I have contributed capital and the entity decides to close down. We decide to close down the entity owes back that money to us. So, what is happening? As of today, there is a capital contributed by two of us. I am just telling you. So, the capital contributed by two of us, what is the capital contributed by two of us out there? I think, am I okay? Yeah, 20 lakhs out here. Let me just do this 1 second. I am just going to keep it this way. Okay. Capital contributed by two of us. So, what happens? The business, moment we have contributed, the business has taken, XYZ has taken that money. So, XYZ owes that money back to us when the entity is closing down. So, that is where it is owing out there. Now, imagine that 20 lakhs is in the form of hard currency, or it is deposited in a bank account. For example, it is, I have deposited, each one of us have opened an account called XYZ, and then we have deposited 10 lakhs in that account out there. The account is owned by XYZ company, not by us. We are signatories for the check, that's all. It is owned by XYZ. Now what is happening? There is 20 lakhs sitting in the bank account of XYZ, or 20 lakhs cash which is in the cash box of XYZ. So what is happening? The entity owns that money. That is what I would say, bank / cash, depending on whether you are depositing in the bank or cash. What is the money it owns? So it owns about 20 lakhs. So in short, what is happening? The XYZ owes that money to the owner, people who have provided that capital, agreed. So that is where it owes. But as of today, the money in the cash box, the cash in the cash box is owned by whom? Owned by XYZ. So what is happening? Bank is 20 lakhs. So there is a transaction that has happened, and you will actually see it being reflected in the balance sheet out there. So every transaction out here that basically happens out here will obviously get reflected in the obviously reflected in the P&L or balance sheet, depending on one of these P&L and balance sheet, whatever it is out there. So it will get reflected. Now, sir, there is no, that 20 lakhs, is it a revenue? It is not revenue. It is not earned by the company. It is a capital that is contributed. So the company owes that money back. It is not earned by the company. If it is earned by the company, then it will be in the revenue side, the P&L or the revenue side. It is not earned by the company as of now. Okay. Let me take up one more transaction. I am going to take up number of transactions, about half a dozen transactions, for you guys to understand the interactions between the profit and loss statement and the balance sheet out. This is, let us say, as of balance sheet, as of XYZ, as of day 1. whatever may be day 1. You can say today is day 1 or whatever is the date you want, you can put it up out. Now immediately with the capital, I go out and buy what is called as a machinery. I place order for a machinery and take delivery for a machinery out there, machinery for plant and machinery. Now the machinery costs about 50 lakhs. I have paid 5 lakhs in the form of a check because or cash, whatever it is. The other 45 lakhs I have signed a mortgage. I have signed what is called as I have signed a promissory note where I will pay at a later stage. Other 45 lakhs I will pay at a later stage. That is, the machinery cost is 50 lakhs. I have bought the machinery. So, moment you have bought the machinery, who is the one? I means XYZ, on behalf of XYZ. XYZ has bought the machinery. So, that means you have bought a machinery worth 50 lakhs. Now, what has happened? The XYZ as an entity owns the machinery which is about 50 lakhs out there. Am I with you on this? When you own a machinery which is about, sir, you have not paid for it. You have not paid for it is not my problem. Who owns it? The ownership has transferred. Imagine, you go and buy a car today. You take a loan from a bank and buy a car. The car is registered on whose name? It is registered only on your name. You will have to repay the loan to the bank. That is an independent transaction that is going to happen. But the car is owned by whom? Car is owned by you. So, the ownership has transferred to you. Loan what you have taken is independent. That is a separate transaction. In this particular case, I have bought a machinery for 50 lakhs. So, what has happened? The machinery is owned by whom? Owned by XYZ. So, what is happening? I have own what I own, machinery. What is the value of machinery? 50 lakhs. Now, what has happened? Have you paid this 50 lakhs? No. What have I paid? I have paid cash of 5 lakhs only. So, what is happening? The cash balance you owned how much? You owned 20 lakhs cash balance earlier. Now, how much is there? You have paid about 5 lakhs. Please look at the formula bar out here. This I am typing it. You had 20 lakhs of cash. You have paid 5 lakhs. So, what is the cash remaining? The cash that you own now is only 15 lakhs. Okay. Is it all? Well, no. Because the 50 lakhs machinery I have bought, 5 lakhs I have paid cash. The other 45 lakhs, what have I done? I am liable to pay. I owe the money. When? Maybe after a year, maybe after 6 months, maybe after 3 months. That will let us not worry about all that. But you owe the money to him. To whom? To the fellow who has sold the machinery to you. Do you owe the money? Yes. So when I owe the money, where does it come? It comes here. What is the money you owe? The money that is to pay for machinery purchased. How much you have to pay? You already paid 5. So you have to pay 45 lakhs. So what is happening? Balance sheet, you will say, look at the total of the balance sheet, oh, that assets are 65 lakhs and liability 65 lakhs, liability plus equity, let us not worry about all that. Yes. So what is happening? For now, what is happening? Every transaction that has happened is finding a place here, is finding a place in the balance sheet. I want to take one more transaction. I have rented a factory shed, same day, day 1. I have rented a factory shed for a monthly rent of 30,000 by paying an advance amount of 2 lakhs. By paying an advance amount of 2 lakhs I have paid and monthly rent of 30,000 payable at the end of the month. Payable at the end of the month. Now what has happened? I have hired a place. Is there a transaction? As of now, no, I have only hired. I have paid for a monthly rent of 30,000. Yes, when is the rent due? End of the month. So when is the financial transaction going to happen? End of the month. As of now, no. But I have paid an advance of 2 lakhs. So what is happening? When I have paid an advance of 2 lakhs, the money of 15 lakhs what I have will reduce by 2 lakhs. Agreed? The money I had 15 lakhs here. Now when I have paid 2 lakhs out of it, now what happens? The money what I have reduces by 2 lakhs, I have reduced. Now further, your money is with him. Your money is given as advance. Supposing you decide not to run the factory, you imagine you got a fantastic offer somewhere else to join as a CEO of another company and you want to join. You want to shut down the factory on day one. So what happens? You are eligible to get the 2 lakhs that you get 200,000 if you have to say, or 2 lakhs whatever you call it. You are eligible to get the 200,000 back from the fellow to whom you have given it as an advance. So what happened? Your money, the money is owned by whom? You. Cash. You are eligible to get it back from him. So what happens? Advance. Advance what I paid for factory premises, that is 2 lakhs. No, you don't have the 2 lakhs, sir, with you. Yes, I don't have the 2 lakhs. But the day I vacate, I will get that money back. For example, you see here capital. Capital, the day you close down, you have to give the money back to the people who have contributed. So similarly, the day you vacate the factory premises, they have to get the 2 lakhs because that money is yours out there. So what happens? That is what happens. Now I go to day 2 of the organization. Let us say, look at day 2. Not changing. Oh, I'm sorry. I put it in the wrong place. I'm sorry. Now I am putting on day 2. Let me say this. Let me take a transaction. I purchase raw material on 30-day credit, I'm sorry. I purchase raw material worth about 5 lakhs on a 30-day credit. 30-day credit. I have purchased raw material worth about 5 lakhs on a 30-day credit. Now what has happened? Raw material is in your possession. Agreed? Raw material is in your possession. The ownership has transferred. So what is the worth of the raw material? 5 lakhs. Now who owns the raw material? XYZ owns the raw material. So what is it? It's an asset for XYZ. So raw material. It's an asset for XYZ. Because who owns it? XYZ owns it. Have you paid? No. You are liable to pay. Sir, it is payment only after 30 days. After 30 days is fine. But are you liable to pay? Yes, I am liable to pay. Do I owe the money? Yes, I owe the money. How much do I owe? I owe 5 lakhs. So what is happening? The money that I owe, creditors. So I owe 5 lakhs back to that fellow, from whom he has supplied the raw material to me. He has given the raw material to me. I owe that fellow 5 lakhs. So I have creditors of 5 lakhs. Continuing this, so far I have not involved the income statement and the P&L. Let us involve the P&L statement also. Now I move to day 3. Let us say balance sheet as of day 3. Now I say that I use, please note my statement, I use 1 lakh rupees worth of raw material, produce a final product and sell that final product for 1.5 lakhs. I use that 1 lakh worth of raw material, produce a final product and sell the final product for 1.5 lakhs on a 30-day credit. Very complicated? No, very simple. I use 1 lakh worth of raw material produce a end product, sell it for 1.5 lakhs on a 30-day credit. Now what has happened? First thing, I've used 1 lakh worth of material. So the material what I own is 5 lakhs. Now that 5 lakhs worth of material I have utilized. I've utilized how much? I utilized 1 lakh worth of material out there. So 1 lakh is gone. So now I own only 4 lakhs worth of material because I've utilized 1 lakh. Moment you have utilized, what happens? It becomes an expenditure for me. It becomes an expenditure, that is raw material utilized. How much is the raw material utilized? I have utilized 1 lakh worth of raw material out there. I have utilized what is called as 1 lakh worth of raw material out here. I'm sorry. I have utilized what is called as 1 lakh worth of raw material out here. So I have basically utilized 1 lakh worth of raw material out here. Next, once I have utilized what I own has dropped from 5 lakhs to 4 lakhs. Once I have utilized, it becomes my expenditure. I utilize. What did I say? I produce the end product, sell it for 1.5 lakhs on a 30-day credit. So what has happened? Revenue. What has happened? Accrued concept now. Revenue has accrued. As the revenue accrued, yes, I have made a sale. My sale is worth about 1.5 lakhs. My sale has taken place. Ownership of the finished goods is not with me, it has transferred. Once it has transferred, what has happened? The sale has occurred, the revenue has occurred. But have I got money? If I have got money, my cash balance will increase. I have not received the money, but I am eligible to get it. I am eligible to get it. That is, it is an asset for me. So, because my money is with somebody, how much? My money is with somebody for about 1.5 lakhs and I am eligible to get it. I am eligible to get that money of 1.5 lakhs. So, basically that is what happens out here. Now your question comes in, sir, the balance sheet is not balancing. The balance sheet assets is equal to 70 lakh 50,000, liabilities only 70 lakhs. Why is the balance sheet not balancing? Now let us come to that. Let me move ahead in this. I am just going to do this, what is called as, I am just going to say, I am just going to calculate what is, oh God, okay. I am just going to, the balance sheet, you say, oh, it's not balancing, what is the problem? Let us not worry about it. Let us start off. Let me total what is the revenue out here. Now, revenue total of my revenues is basically about 1.5 lakhs. Same thing I am going to do for my expenditures out there. My expenditures out there. Let me pay what do my expenditures out there. My expenditure is 1 lakh. What is my profit before tax? The profit before tax is revenue minus my expenditure is just the profit before tax. As of now, let us keep the tax 0. So, what is happening is profit after tax is so much out here. Let us not worry about dividends, let us keep the dividends as 0. I will explain what is the dividends out there. Let us sort of do that also little later. So, what is happening? There is what is called as out here, the profit is only about 50,000. Now, to whom does this profit belong? The profit first of all belongs to the capital provider. The person who has, because why has my T.A. Suhail and myself contributed 10 lakhs to the business each? We have contributed 10 lakhs each to the business because we are expecting the business to make a profit and that profit coming back to us out there. So, what is happening? The profit always belongs to the capital provider. The profit belongs to the capital providers out there. let us be even more specific as we go along. Equity providers, let us keep that equity aside, and then I'll come to the equity in the next few minutes, or maybe in the next class or whatever. So this profit, I have made a profit. You see that I have made a profit of about 50,000 out there. This profit belongs to whom? Profit belongs to the capital provider. Who is the capital provider? There are two guys who have provided capital of 20 lakhs. Why have they provided capital of 20 lakhs? In anticipation of a profit. Sir, if they make a loss, what happens? If they make a loss, they lose money. Not a problem. If they make a loss, they lose the money out there. That's all. The capital gets reduced in the process. We will see all that. So what is happening? Now what happens? The money, this profit belongs to what is called as the capital providers out there. Sir, why are you writing it as retained earnings? I'll come to that. I'll come to that in the next few minutes out there. As and when the profit change, this profit will basically goes to the capital provider. The profit basically goes to the capital provider. So what happens? The XYZ is liable to pay the profit back to the capital provider. I repeat, XYZ is liable to pay the profit to the capital provider. That is where it is appearing on the liability plus equity. It is liable to pay. Normally there is a question. Profit is good? Yes. Then why does it appear on the liability side of the balance sheet? Because of the simple reason that the profit belongs to the capital provider. So you are liable to pay it back to the capital provider. So that is what basically we look at. Now you can see the balance sheet would have automatically sort of balanced out there. Now let us take up more examples. Let's take up more examples. I've got a complete list of transactions. With this, we will do it. This is a sequence of transactions for about 2 months. I've just tried to build it. We will do it as we go along. But let us take up some rough just off the cuff transactions, and so that you will understand this better. Oh, the income statement. This is for the period. Let us say I'm not giving any specific date here. Normally date is given. I will say day 1 to day 3. Day 1 to day 3. Now day 4. Now the day 4. You want to, what do you call it as, purchase some office equipment out there. You want to purchase a laptop or whatever office equipment. Let's not even worry about what's equipment. You purchase an office equipment partly by paying cash and partly on credit, say 50% on cash and 50% on credit, or about 3 lakhs out there. You purchase an office equipment, whatever might be the equipment, by paying 50% cash and 50% on credit. So what is the worth of the office equipment? 3 lakhs or 300,000. Who owns the office equipment? It is owned by the company XYZ. So what happens? The company owns office equipment, is owned by the entity 300,000 out there, or 3 lakhs, whatever you might want to say, it owns it. Now what is happening? Sir, is it not an expenditure? There is a question. Why are you writing it as an asset? Is it not an expenditure? Expenditure occurs only when you have enjoyed the benefits of the money that is spent out there. That is notional money, or only for the money that is spent. In this particular case, 300,000 worth of equipment I have purchased. It is new. I have not even opened it. It is still in the plastic cover. Have I enjoyed the benefits of it? No, I have not enjoyed the benefits of it. So it is still there. It is owned by me. So it is an asset for me. Expenditure is only when you enjoy the benefits. So now, in this case, how much have I paid? I have paid about 1.5 lakhs or 150,000 cash out there. So what happens? My cash balance reduces by 150,000. I am liable to pay another 150,000, that is to pay for office equipment, how much you have to pay? You have to pay about 150,000. I am yet to pay 150,000 to pay. So we saw that you are liable to pay 150,000 on the office equipment. That is where it is on the liability side. You have paid 150,000 cash, so cash has gone down. Now you own the office equipment for about 300,000. So what is happening? Any transaction that takes place will find a place in your financial statements, P&L and balance sheet. Now I missed to tell you one aspect out there. I said retained earnings 50,000. That is what the profit belongs to the capital provider. So I have written it there. Then why did I use the word retained earnings? Because that is the earnings of the company which is retained in the company itself. It is not distributed still. If it is distributed, it will be distributed in the form of dividends. As long as it is not distributed, it is retained in the company, it is retained earnings. Earnings which is retained within the company XYZ. Earnings which is retained within the company XYZ. Supposing the company says, out of the 50,000, I am going to pay 10,000 as dividends. That means what is the money that is getting retained? 40,000 is the money that is getting retained in the company. When you pay 10,000 dividends, what happens? Your cash balance also reduces by 10,000 because you are paying 10,000 out there. Now let us not keep dividends, so I am going to undo it out there. So that is what is retained earning. Now whatever you are seeing now is very interesting. For every transaction, there are always two sides of a transaction. There are always two parts of a transaction. That is what in accounting terminology we call it as double entry system of bookkeeping. Double entry. For every transaction, there are two parts. Either, for example, let us say a sale took place for 150,000. My revenue increased. My asset also increased. That is, I have to get money. I utilize raw material, my asset reduced, my expenditure increased. When somebody contributed capital, what happens? My liability, that is the money that I owe, went up. My cash, that is asset, also went up. When I buy office equipment, what is happening? Asset is increasing. And what is called as, if I have paid, my cash has gone down. Because I have not paid, my liability increases. In this case, partly I have paid, partly my liability is increasing, partly I have paid, so cash going down partly, liability increasing partly. So what happens? Every transaction will always have a minimum of two parts. It will affect every transaction that I take, any transaction that I take. There are four heads here: assets, liabilities and equity, revenue and expenditure. Out of the four heads, it will definitely impact the minimum two heads out there. It can impact the same head twice, not a problem. Same head twice, sir, I didn't understand. Don't worry, we'll make it now. Let us keep this bank and cash as bank. I am just going to remove the cash. Imagine all the money is in the bank. I withdraw from the bank 1 lakh for meeting the day-to-day cash expenditure. I withdraw from the bank 1 lakh for meeting the day-to-day cash expenditure. That is petty cash expenditure. So what is happening? I am withdrawing from the bank. When I am withdrawing from the bank, my bank balance is reducing by 1 lakh. My bank balance is reducing by 100,000 or 1 lakh. When my bank balance is, but what happens? My bank balance has reduced. Asset is impacted. Now that 100,000 cash is in my cash box in my company, is in the cash box in the company. Who owns the money in the cash box? Again, XYZ owns the money in the cash box. So what is it? It is owning cash. How much? It is owning cash of 100,000. It is owning cash of 100,000. That is, It was in the bank, I have taken it out of the bank and kept it in a cash box out there. So both I own, the bank account dropped, the cash balance increased out there. So the asset has got impacted twice, you can see that. So any transaction you take, minimum it will impact 2 out of the 4, maybe the same thing, maybe the same head it can impact twice, like what we saw now, maybe the same head impact it can impact twice, but certainly any transaction you have taken, it will impact minimum 2 heads out of the 4. We saw that in this particular case. I have purchased a machinery, what happened? My asset increased. I have to pay for the machinery, my liability increased. By how much? Not the equal amount, because I had paid little bit from my bank account. So what happens? My assets slightly decreased and my liabilities went up in the case. So every transaction, I can take any number of transactions out there, it will impact minimum 2 heads out of the 4 out there. Minimum 2 heads out of the 4. So that is what we call it as double entry system. Every entry will have a, what do you call it as, every transaction will have 2 parts. I am going to take more transactions. Now it is that, instead of what happens, let us move to day 30 out there. Now day 1 to day 30, let me make it day 30, end of the month. I have not had any other business out there for the next 28 days, I am just still consolidating the whole thing. Now day 30, there are a couple of things that happen. I have to pay salaries for my workers. I have to pay rent for the factory premises. Now first thing, let me say, I am paying rent of 30,000 for my factory. When I pay rent of 30,000 for my factory, what happens? My bank balance will reduce by 30,000 because you are giving a check. So how do I know it is cash or check? Normally transaction, unless it is petty expenditure, all transactions will be out of the bank. So let's keep it that way. All transactions will be out of the bank unless it is very petty expenditures. Now what has happened? Bank balance has reduced. Correspondingly, there has to be one more head has to be affected out of the 4. Now, have I enjoyed the benefits of that place for 1 month? Yes, I have enjoyed the benefits of the place for 30 days. So when you have enjoyed the benefits for the place and you are paying 30,000, what is it? It is nothing but an expenditure, that is what is called as rent of about 30,000. Moment you have a rent of 30,000, what happens? Your profit drops. Your profit drops to 20, your retained earnings drop to 20,000 out here automatically in this particular case. Because when am I paying? On day 30th, enjoyed the benefits for 1 month, then I pay. I have my workers who are paid a salary. Imagine I have two what do you call it as 2 foremen out there, or 2 casual labor out there. Let us say casual labor to operate the machine. No, because they are operating the machine, the casual labor, only 2 fellows, because it is a new company. I am paying them a salary of 15,000 rupees per month to each of these fellows, each one, casual labor, 15,000 rupees. So 2 casual labor, salary to 2 casual labor, and they have been employed through the month. So how much am I paying? I am paying about 15,000 per person into 2 people. So 30,000 is the money that I paid, because it is an expenditure. Why? They have worked for me for the entire month. They might have sat idle, but they have devoted their time to me for the entire month. So I am liable to pay. So I have, imagine it's gone. Moment I pay, what happens? My bank balance reduces by the same amount out there. My bank balance reduces by the same amount. Yeah. Sorry, there is a mistake in this particular case. What happened? Oh, I did something here. Okay. Minus this. So my bank balance has become 990,000. Now most importantly, what happened? My retained earning became negative 10,000. That is, I have started making a loss of 10,000. Now what happening? The next aspect out here in this particular case that I want to convey out here is the net worth of the business. What is the net worth of the business? That is what we talk about, is called as accounting equation out there, and net worth of the business. I am going to go to my pen and paper out here and let us look at it. That is what we say. We say that always as this and this. Okay. We say assets minus liabilities is equal to capital, or whatever you can say, capital plus liabilities is equal to asset. So this is what we call it as account. That means, what am I saying? Let us go back to the Excel sheet. I will be able to explain it better. I sell all the assets. Imagine I sell the machine for 50 lakhs, it goes for 50 lakhs. Imagine I sell the equipment, office equipment for 300,000, it sells. The bank balance is there. I have received the advance back from, what do you call it as, from the owner of the premises. I sell the raw material, I collect money on the debtors, I collect and then I have a cash. So what happens? I am able to raise about 71 lakhs 40,000 out there. I am able to raise about 71 lakhs 40,000 out there. Now I use that for paying the liabilities. Out of the 71 lakh 40,000, if I pay 45 lakhs to machinery, 1.5 lakhs to office equipment to whom I owe, as well as creditors another 5 lakhs out there, whatever money left is what we call it as the capital, or what we call it in this particular case as net worth of the business. What is net worth of the business? Capital plus, what do you call it as, the money, that is all the money that belongs to the shareholders, is what we call it as net worth of the business out there. In this particular case, I am going to write it in different color. That is, I sell all the assets, I generate so much of money. I pay off these liabilities. What am I left with? I am left with only this much. That is 19 lakh 90,000. What was the capital? Capital was 20 lakhs initially. Now what is the capital? 19 lakh 90,000. So what happens? Today on day 30th, me and Suhail decide to close down the business. We might get only 19 lakh 90,000 to be divided between the two of us. What has happened? We have lost about 10,000 in the process of running the business for 1 year. So that is the loss. So when we say net worth of the business, I just have to correct this total out here. Instead of 5, it is out there 7. So what is happening? In the process of operating the business, we have lost, our capital has reduced, that is, we have consumed the capital out there to the extent of 10,000. So now our capital is worth only 19 lakh 90,000. So in short, what is the business worth? The business is worth only 19 lakh 90,000 out there as of today. Why? Because I sell all the assets, I generate cash from the asset and I pay off all the liabilities. What is the money left? The money left is what we call it as the capital out there. The capital, which was 20 lakhs, has become 20 lakh 90,000. Now I will say, imagine on day 30th, you have a sudden windfall gain. Suddenly there is one order, and that order is, say, let us say you use about 50,000 worth of raw material and sell the product for 75,000 cash, or money received immediately in the bank account. You use about 50,000 worth of raw material. That is, moment I use 50,000 worth of raw material, what happens to my asset? My asset is going down. So what happened? I have utilized raw material used for second order. Order 2, how much? 50,000. I produce, I sell it, that fellow is prepared to buy it, and he pays me by it, gives me, transfers the money to my account. I sell it for what? 75,000. Sale of the second order. What is it? I sell it for 75,000. Immediately what happens? He has given money. That is what double entry. He has given me money and the money is transferred to my bank account. My bank balance increases. Now what happens? Your retained earning, you have come out of the red and it is positive. That is, you have made a 15,000 rupees profit out there. So what is happening to your net worth? Net worth is 20 lakh 15,000. We had contributed 20 lakhs as capital. Now that capital has become 20 lakh 15,000. The capital has grown in the process. That is, I sell all the assets, I pay off the liabilities, I will be left with 20 lakh 15,000 to be divided between the two. Do I divide it equally? Do I divide it differently? Let us not worry about that. To be divided between the two of us. And you can see my revenue was 225, my expenditure is 210, I make a profit out here. Now, if I take, as long as I don't take the dividend, the money is retained in the company and that belongs basically to the company. I can take more examples out here. One or two more examples I will take. For example, imagine it is the next day, this particular month has 31 days out there. So, 31 on day 31, balance sheet is on a particular day and P&L is for a period that is 31 days, day 31. I purchased the raw material for 350,000. For whatever, I purchased raw material worth about 500,000 on credit for 500,000. I have to pay. I purchased on how many days credit? 30-day credit. So what happens? I have to pay today on 30-day credit. So when I pay on 30-day credit, when I pay, what happens? When I pay, what happens? My bank balance, which was basically so much, now reduces by 500,000 out there. My bank balance reduces by 500,000 in the process. Corresponding, out of the 4 heads, another head which is going to be impacted. I owed somebody 500,000. I owed the creditors 500,000. Now do I owe once I pay them? No, I don't owe them any money. I don't owe them any money. My bank balance has reduced, asset has reduced, my liability, I owe them money, that has also reduced. So basically, balance sheet is taken care. So what is happening? Double entry. For every transaction, there are 2 parts. This, did I do plus? Yeah, I am sorry. This is minus. Because when I pay, it is always minus, it cannot be plus. That is where the balance sheet is not balanced. Now it will be okay. When I pay, it is always minus. Cash bank balance goes down. That is what I was wondering. How is it? Now I sold for 1,50,000 something out here. And that fellow has to pay me. Imagine he also pays me on the same day. He also pays me. Then what happens? My bank balance now increases by 1,50,000. My bank balance increases by 1,50,000 out there, and I am eligible to get from somebody 1,50,000. Now once he pays, I am not eligible to get it from him because he has already paid out there. He has already paid and that's gone. He has already paid and that's gone out there. So what is happening? In this case, we saw the same hit getting impacted twice. Bank was increasing, bank balance, my debtors was reducing out there. The asset is getting impacted twice out there. So bottom line, out of the 4 heads, every transaction will have to impact 2 of these 4 heads. So you have to keep that in mind. And every transaction will find a place only between these 4 heads out there. Revenue, expenditure, liability and equity and assets out there. It will not go beyond this. It will find only a place within these 4. Now I'm going to explain one more aspect and I'm going to close the class for the day and then we will sort of discuss it later. Now I'm going to go back here. The next aspect that I would like to discuss is I had mentioned, and one second, I will just move the keyboard in because I am not going to use the keyboard now. I said I had mentioned what is called as something called as equity. Now, what is this equity? Let us understand what is this equity because we are going to use this in the next class. Equity is a form of capital to the business. Now, equity, normally they will say equity, we call it as equity shareholders, equity shares. Sir, what is equity shares and what is equity? Is there a difference between the two? No. Supposing, imagine hypothetically that my business needs a capital of about 100, as about 10 lakhs out there. 1 million, in otherwise it needs a capital of 1 million or 10 lakhs, whatever it is. Now this 1 million or 10 lakhs I can divide into 100,000 or 1 lakh shares of 10 rupees each or $10 each. What do you mean divide? 10 lakhs is the capital cash I require. I will say I will decide to print what is called as a share certificate, and I will say each certificate is worth about 10 rupees out there. I have divided this into number of shares. I have divided this into 1 lakh shares of 10 rupees each. I have divided this 10 lakhs. I will say, imagine I print 1 lakh share certificate and each share certificate is worth 10 rupees. So, you can pay 10 rupees and buy a share certificate out there. So, that is what it is. Now, when this is divided into shares, these normal shares are called as equity shares. Now, what is the advantage of equity shares? There are equity shareholders. Number one are the decision makers of the company. When I say decision makers, they have what is called as a voting right in the company. They decide what should the company do, what should not the company do, etc., etc., etc. out there. Now, it is equity shares, that means equity shareholders are owners of the company. So, I own one equity share. Do you mean to say I am owner of the company? Yes, you are an owner in the company to the extent of one equity share that you are holding. For example, let us go back to this previous page itself. There are 1 lakh equity shares of 10 each. I hold 50,000 shares out of that. Then I hold the majority. The other 50,000 is divided among another 100 people out there. But I hold the majority. So, I get to basically make most of the decision because I have more voting right. Why? Because I have each share has one vote. I have 50,000 shares. I will have 50,000 votes out there. So, it does not mean that you own one share. So, you have one vote in the process out there. You own 10 shares, you have 10 votes, you have 100,000 shares and so on and so forth out there. So, you are the owner of the company, you are owner of the company to the extent of your holding. I repeat, you are an owner of the company to the extent of your holding. You are holding one share. Imagine 1 by 1 lakh is your holding. I am holding 10 shares, 10 by 1 lakh is my holding. I own 1000 shares, I am 1000 by 1 lakh is my percentage of holding. So, that is how this holding is basically there. That is where I will say you are the owner, you have the voting right, you get to make the decision. Once all these things are there, you are obviously also eligible to the profit or loss of the company. You make a profit belongs to you, it is getting distributed as dividends for your equity shares. You make a loss, then value of equity is basically going down in the process out there. So that is what happens. Now what is it? The company makes a lot of loss. Then will they come and take over my personal assets? No, your liability is limited. When I say liabilities, I have bought one share of 10 rupees. The company makes humongous amount of loss and the company's net worth is eroded, net worth is negative. Net worth can become negative if the loss is more than the capital contributed. If the loss is more than the capital contributed, I am seeing here, if this retained earnings of plus 15,000 is negative, more than 20 lakhs out there, then what is the net worth? Is negative. What is the company worth? Negative out there. So in this particular case, if it is negative, what is my liability? My liability is I have got one share, that share is gone now. Now it is not, it has 10 rupees worth, now it has become like a tissue paper. I have just lost that. I have just lost that. That's all. My liability gets limited in the process out there. That is all happens. But I am eligible to the share in the profit out there of the company. So you are an equity. I have given you very crude definitions. Equity shareholders, owners of the company, yes. Equity shareholders, voting right, yes. How will the equity share make money? They will make money in the form of number one, of course, dividend. Number two, in the form of capital gain. What do you mean by capital gain? They can sell the equity shares in the market, in the stock market. You have the NSE stock and market BSE, etc., out there. You sell the stock in the market. A 10 rupee share, you can sell it for 1,000, 10,000, 20,000, 40,000, whatever is the price that is getting quoted in the market, you will sell. Why will somebody buy the 10 rupee share from me for a higher price? He will buy it from me for a higher price because he anticipates the company to perform better and make more profit in the future and give more dividends in the future. I repeat, because somebody buys it from me at a higher price because he anticipates the company to make more profit in the future and then give more dividends in the future and so on and so forth. So that is what it is, and that is what we call it as the capital gain out there. So equity is a form of capital, they are the owners. That is where we say liabilities plus equity. It is not a liability for the company. It becomes a liability only when the company is winding up. Otherwise, the company is not going to pay the equity shareholders unless they do a buyback. They are not going to pay the shareholders. So what happens? They are going to pay only dividends. The share is not going to be cancelled. It is only on the day they wind up. So that is where we say liabilities and equity. Why? Because we say liabilities plus equity in this particular case. That is what in this particular case I would say. In this particular, assets minus all the liabilities is what we call it as equity capital. I repeat, I correct it here. Assets plus liabilities is what we call it as equity capital. In this particular case also equity capital plus liabilities is equal to assets out there. I hope I'm clear. The next class I will talk about it. We will take up some of the, I will upload, there is what is called as a set of transactions. I am going to drop all these transactions on the P&L and the balance sheet out there on an Excel, so that it will help you understand the P&L and balance sheet better and the interactions between the P&L and the balance sheet better. Thank you.